This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Hello and welcome to AI Market News by LM.
Hello. So we've dug into a range of sources covering the market action for Friday, October 10th, 2025. And, well, the mission today is really to try and cut through some of the noise.
Absolutely.
What we're seeing is this kind of strange situation. The US dollar is making some serious gains, even with the government shutdown continuing. But at the same time, that AI rally, it seems to be hitting a bit of a wall, a physical one.
Yeah, that's the core tension, isn't it? This push and pull between, all that enthusiasm we've seen and these real-world logistical limits. So today, we'll dive into why US equities are taking a breather, what's causing the turmoil with the Japanese yen, and, crucially, what the latest consumer data might be telling us, especially when the government itself is sort of flying blind on inflation stats right now.
Okay, let's kick off with US equities then. The main thing isn't some big crash, but more like a pause, maybe a necessary one. Our sources show US indices pulled back a bit overnight. Seems mostly driven by caution around tech valuations.
Right, the Dow was down about 0.5%, S&P 500 maybe 0.25%. But here's the interesting part for me, the NASDAQ, and the engine of this whole rally.
Yeah.
It dipped just 0.08%, barely anything. That suggests there's still some underlying strength there, wouldn't you say? Even if the upward momentum is slowed?
It does seem that way. And what's also fascinating is that despite those overnight dips, U.S. index futures are actually ticking up slightly heading into the U.S. session.
So the buy the dip crowd is still active.
Looks like it. That mentality has been strong all year, but, we have to ask. Is this just optimism, or is the market maybe underestimating some of these new hurdles?
And these hurdles are physical, which, like you said, is where it gets really interesting. Volatility is creeping up a bit. The VIX is at 16.49.
Right, that little jump, based on the fear and greed methodology, signals a bit more fear creeping in. And there are definitely concerns about frothiness in certain tech areas.
Even though some analysts argue the big hyperscalers have strong cash flows backing their investments.
True, but the source material highlights this fear isn't just valuation jitters, it's logistics. We've actually seen Microsoft, one of the biggest players building these huge data centers, admit their capacity crunch. Well, it's likely sticking around into 2026 now.
Wait, 2026? That's way beyond their earlier forecasts.
It is. It extends past their previous guidance.
So this isn't just about profit-taking or interest rates anymore. We're talking about actual physical bottlenecks. Like, they can't build fast enough?
That seems to be a major factor, yes. It really changes the narrative for the whole AI theme moving forward.
Absolutely.
I mean, think about the scale. Azure brought in $75 billion in revenue last fiscal year. A massive growth engine.
Huge.
And now it's constrained because they literally can't build data centers fast enough to meet the demand for cloud and AI services.
Wow.
This really underscores that the AI expansion is bumping up against real-world supply chain limits, everything from power transformers to just physical space.
That's a critical insight for anyone invested in this space. Okay, so if risk assets are pausing, partly because of these supply limits, where's the capital going for safety? Which brings us, naturally, to currencies.
Yeah.
And the US dollar is just dominant right now.
It really is. The dollar index, the DXY, is sitting around 99.080. Down slightly today, but the key thing is it's just locked in its best weekly gains since November 2024.
And this is despite the ongoing US government shutdown.
Exactly. It's remarkable.
It feels counterintuitive. A strong dollar when domestic politics are messy. Why is it so resilient?
Well, based on the inputs, it seems to be largely what they call a pain trade for investors. It's driven by weakness elsewhere and also some cautious signals from the Fed. Basically, the dollar is winning by default against other major currencies.
The cleanest shirt in the laundry basket, as they say?
Pretty much. And the main source of that external drama right now, Japan. The yen.
Ah, yes, the yen.
Yeah.
USD-JPY is around 152.79. And the yen has weakened significantly this week, hasn't it? Down over 3.45%.
Yeah, huge move. And that kind of speed is almost always tied to political risk.
The TAKAICHI trade.
That's been the driver. It centers on the incoming leader, TAKAICHI, and her proposed economic plan. Some call it Sananomics. Very aggressive fiscal stimulus, expansionary policy, stuff that usually pressures the yen downwards.
And the markets reacted instantly when she was selected. But the sources mentioned a sudden shock this week, too.
They did, a big one. The unexpected news that the Komeito party is leaving the ruling LDP coalition. That throws massive political uncertainty into the mix.
How?
Because the coalition collapse means TAKAICHI's LDP falls short of a majority. So her ability to actually enact those bold fiscal policies, the core of Sananomics, is now seriously in doubt.
Right, so the political chaos, ironically, might make it harder to spend aggressively, which maybe help the yen temporarily.
Precisely. The initial reaction was a sharp, though brief, buyback of the yen. Traders figured political gridlock makes big fiscal easing harder, which maybe gives the Bank of Japan more room to potentially hike rates down the line.
But the overall instability keeps the yen weak.
Definitely fragile. Analysts are warning that any Bank of Japan intervention would probably only slow the decline. If it hits 155 or higher, we might see some serious warnings.
And the euro isn't exactly stepping up either. USD is hovering around 1.1571.
Still pressured. Political uncertainty in Europe, especially in France, with coalition talks and potential shifts, continues to weigh on the currency, keeping it near those August lows.
So, looking at the dollar's strength, it really is a relative safety story. Capital seems to be fleeing political risks in Japan and Europe, and even with a US shutdown, the dollar looks like the safest bet.
That seems to be the prevailing dynamic.
Okay, let's pivot from fiat currencies to, well, the asset that seems to be thriving on all this global anxiety, gold. It's holding above that huge $4,000 per ounce level, trading around $4,006.85 now.
Yeah, breaking $4,000 was a major psychological and financial milestone. This rally seems driven by some fundamental worries about global fiscal stability, including that U.S. shutdown and the debt ceiling hanging over things.
The sources highlight two main drivers, right? First, ongoing buying for central banks.
Yes, sustained sovereign demand. Central banks, notably China, now the world's sixth largest holder, apparently actively diversifying away from the U.S. dollar.
And second,
Gold's classic appeal as a hedge against debasement. Analysts are calling it part of the broader debasement trade. Investors seeking hard assets like gold as protection against inflation, against currencies losing purchasing power. Deutsche Bank specifically pointed to the dollar's falling share of global reserves funneling money into gold.
and with central banks still buying, some analysts see this rally continuing, maybe even towards $5,500 next year.
That's what some targets suggest. It tells us this isn't just a short-term blip. It might be driven by deeper structural shifts in how countries are managing reserves and risk.
Okay, quickly on energy. Oil prices reacted pretty sharply yesterday to some geopolitical news.
They did. WTI crude and Brent crude both pulled back a bit, around 0.6% down.
And that softening seems directly linked to the announcement of a tentative ceasefire between Israel and Hamas.
That's the attribution, yes. That immediate sense of de-escalation took some of the geopolitical risk premium out of the market that had built up during the week.
But the market's still cautious.
It seems so. OPEC Plus is continuing its very measured, cautious approach to unwinding those production cuts. They're making sure spare capacity doesn't shrink too fast, which kind of puts a floor under prices. So we probably shouldn't expect a huge sustained drop, even if tensions ease more.
Right. Okay, let's tie this all together now by looking at the macro pulse. The U.S. government shutdown. It's really complicating the picture by delaying key economic data.
It's creating a huge blind spot for the Federal Reserve, isn't it?
Yeah.
Massive one. We learned the Bureau of Labor Statistics actually had to recall staff just to prepare the Consumer Price Index report.
The CPI, yeah, which is crucial for next year's Social Security inflation adjustments, among other things.
Exactly, and the timing is just awful.
How so?
The BLS is apparently aiming to release the CPI data by October 31st. That's just days after the next Fed meeting on October 29th.
So the Fed makes its decision without the latest official inflation numbers. They're flying blind.
Essentially, yes.
Yeah.
Regarding the freshest inflation picture, they won't have the official print.
Wow, okay. And with that key data missing, the market's expectations for aggressive Fed rate cuts have kind of stalled out.
Understandably paused, yeah. Plus, recent comments from Fed officials have sounded pretty cautious. They're citing risks of tariff-inspired inflation.
Ah, interesting.
So the market seems to be realizing the Fed might not pivot to easing as quickly as people thought, which, going back to our earlier point, is another big reason the dollar is staying so strong.
Right. And in this kind of environment where official data is delayed, alternative gauges become even more important, like the Michigan consumer sentiment data we got today.
Exactly. We got the preliminary read for October and the headline number. It missed expectations, came in at 54.1, below the prior reading in the forecast, suggests consumers are getting a bit more anxious.
But for the Fed, the real focus is probably the inflation expectations within that report.
That's usually key. The one-year inflation expectations came in at 4.7%, the 5-year at 3.7%.
It's still elevated then.
Still quite elevated. It gives us a fresh snapshot, even if it's just sentiment, of where consumers see prices heading. And it's not signaling a rapid cool down just yet.
Okay, so looking ahead for the rest of today, Friday, what else should we keep an eye on? We can check the economic schedule on investing.com.
Right. We've already got the Michigan data digested. The next thing on the U.S. calendar is the federal budget balance, due out at 2:00 p.m. Eastern Time.
Okay, the budget balance. How significant is that right now?
Well, it gives us another read on the U.S. fiscal situation. Could provide some context for the bond market, especially with all the debt ceiling uncertainty swirling around because of the shutdown. The forecast is for a $50 billion surplus, which would be a big swing from the previous deficit.
Got it. So, as we wrap up the week, what's the main takeaway for us? Feels like we're navigating this landscape full of political twists, Japan, the U.S. shutdown, those ceasefire hopes, plus this big tech constraint.
I think that duality we mentioned at the start is key. The U.S. dollar, it's proving incredibly resilient, the go-to safe haven amid all this political risk. But that AI theme, the big growth engine, it's hitting a necessary reality check.
The constraint isn't demand, it's supply.
Exactly. It's physical supply this time. Geopolitical risk pulled back, hitting oil prices, but those deeper structural things driving gold and the dollar fiscal worries, diversification, they seem firmly in place.
So we really need to stay focused on when that delayed CPI data finally drops and keep watching the political developments in Japan and France. That seems crucial for figuring out where risk assets head next.
It does, and it raises a bigger question perhaps for us to ponder. If the world's traditional anchors of stability, places like the US and Japan, are facing significant domestic political turmoil, and the biggest technological growth story, AI, is running into actual physical walls, what's the next big unconstrained investment theme out there? Something to think about.
Definitely something to think about. Thanks for watching. Don't forget to like and subscribe.